You keep hearing about this infinite banking. Have you ever wanted to know what's the scoop? We got you covered.
Brian, I am so excited about this because this gets so much press and we get so many questions asking us about it. Guys, what about infinite banking? Is this what the elite wealthy do? Is this what the top rung of society is doing? Is this the secret financial thing that I need to know about in order to truly be a financial mutant? So in today's show, we want to unpack that.
Well, here's the thing that gets me is insurance is a very necessary part of the wealth building process. What I don't love is somehow in this modern world we live in, you cannot help but turn on social media and people will tell you 401ks are a scam.
Yep.
And it's typically followed by, because where you need to be putting your money is in life insurance, whole life insurance, and even bank on yourself through infinite banking. I'm just glad that we finally have been able to find an insider that would share the details with us so we could do this content. So stick around to watch all the details on infinite banking.
Yeah, that's a great setup, Brian. What we've done is we actually have a listener out there that say, actually, I do this. This is a strategy I perpetrate. And every time you guys talk about this, you're not actually using policies that are designed for this specific purpose. So we asked this friend of the show, hey, why don't you send us some policy design so we can actually do a side-by-side case study to see if this is merited. But before we get into that, for those of you who don't know, for those of you who aren't familiar, infinite banking or bank on yourself is a way in which you use whole life insurance to build up savings and leverage cash values for self-financing. It may be pitched as an alternative to putting your money in a bank or putting your money in the stock market. You instead get to be the bank. So that's the pitch. You no longer need a brick and mortar. You no longer need a financial institution. You yourself can become the bank.
Now, look, I want to play the part of helping you kind of walk everybody through this. And sometimes when I see definitions, it doesn't really tell the full picture, Bo. So how about a visual? Do you have a flow chart or a visual that can help people who maybe are the learners who go beyond the words?
That's exactly right. So here's what you do. You as a policyholder, you're going to pay premiums or send cash into a whole life insurance policy. It's going to be a life insurance policy offered by an insurance company that you're going to pay a premium into every month. Well, with that premium, one of two things is going to happen. Part of it is going to go by a death benefit. If you were to die, a death benefit would be paid out to your beneficiaries. And the other half is going to go to build up cash value inside of the life insurance policy. Well, as that cash value then builds, you as the policyholder can then borrow against it. So if you need to be able to have money to spend, rather than going to the bank and pulling money out of a bank account, you can instead use your life insurance policy as the bank to pull money out of.
Now, I already noticed something that's a little concerning to me, Bo, is that when I talk about life insurance, I'm very familiar with buying term life insurance, which is primarily you are buying the insurance. If something happens to you, you get paid, but it doesn't build up cash value, meaning that there's not an element of investing or making the premium level in a permanent way. But I also noticed the thing that gets me, this says whole life insurance. Why don't you tell us what variables or factors are needed to really set this up? Because that's already a unique thing to be whole life insurance.
That's right. And this is what we were told, again, by our insurance insider. Hey, you got to make sure that you're buying the right type of policy. And so let's talk about the elements that make up this infinite banking policy. The very first thing that you need, what you have to buy, is high dividend paying whole life insurance. Now, you immediately alluded to something, Brian. Immediately, our spidey sense goes off when we hear you have to go buy whole life insurance. Because we know all the time that we talk about term insurance versus whole life insurance. There's a very tangible reason why we like term insurance more.
Well, first of all, life insurance, I think, is a period certain need. Like hopefully the goal is that you're saving and investing, you're building up your army of dollar bills. So hopefully at some point you become self-insured because you're financially independent. You don't need to replace your income anymore because your assets will talk for you or protect you and your loved ones. That's not what I'm seeing here, because when we talk about whole life, the premiums are substantially higher. And I know we even have some research on that.
Yeah, if you look at how much insurance coverage costs, and this is for a female in excellent health for a $500,000 policy, if you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188. Fast forward to a 50-year-old female in excellent health. If that lady wanted to buy a $500,000 policy, she's going to spend about $644 a month for that term coverage. If instead she wanted that same amount of coverage in whole life insurance, it's going to cost over $9,400 a year. So these are very different when it comes to costs of getting that insurance coverage in place.
But it's called permanent insurance for a reason. This is meaning you're planning on buying this policy and holding this policy until you pass away.
Yep.
Whereas term, as the title kind of alludes, is only for a period certain of time. So I'm a little confused on that, but I'll let you keep us on this journey.
So specifically, you want to make sure that you're buying high dividend paying whole life insurance, because you can use other types of permanent insurance, but dividend paying, or also known as participating policies, are the ones that work best. And there's a few reasons why they work best. Number one, the premiums don't go up as with other policies. So you can actually lock in a fixed premium for the life of the loan. The other big way that these policies are sold is that the cash values are guaranteed to go up. If you look at other types of cash value whole life policies, they have a guaranteed rate that says no matter what, we're going to make sure that this goes up. Not all cash value policies work that way. Some of them can actually decrease in cash value. But if you buy a guaranteed whole life policy, you can assure that you're going to have some minimum rate of return that you receive. Now, here's the problem though. When it comes to buying whole life insurance, there are often a lot of very expensive commissions, very expensive fees that go into this. So Consumer Reports came out and said, hey, when we look at all the different cash value whole life policies out there, the average rate of return, and this is including the dividend payments, but with the guaranteed cash value built in, is only about 1.5% per year. So if you look at the average of all the policies out there issued, the average is 1.5%. Now we're going to talk more in a moment about how we're going to try to use a policy that's custom built to satisfy infinite banking, but right there on the start, even though there's a guarantee at 1.5 or around 1.5 does not get me super excited.
That doesn't completely shock me, because whenever I hear the word guarantee, when you're talking about financial products, that's a heavy burden. That's a word, like I know when you're doing securities training, they tell you never, ever use the word guarantee, because that's something that, I mean, if you are taking on risk, that by its sheer nature is not, you're getting risk, you're taking a risk to reach a premium in return. There's a risk reward from that. A guarantee has to be at a lower price point, and that's why there's fees, there's lots of other things. I completely get why a guarantee is going to be a much lower rate of return.
So the first thing, we're thinking about the elements that you have to have, is you have to have a high dividend paying whole life policy. The second thing that you have to have is a lot of cash. So this is a little bit counterintuitive. In order to be able to execute an infinite banking or a bank on yourself strategy, you have to already be someone who can dump tons of cash into these policies. So right there off the bat, that's fairly limiting, right?
Yeah.
Because not everyone has a ton of excess discretionary cash flow that they can throw at this kind of policy. And so the question you may ask is, all right, well, why do I need that? What do I want to be happening with this tons of cash? Well, what you essentially want to have happen is part of the cash you're putting into the policy is going to pay for the premium. The other part, and the premium being what the insurance actually costs, the other part is going to go to building up the cash value. What you want to do by dumping as much cash into this policy as you can is you're buying paid up additions. And what paid up additions are entirely paid for life insurance additions that both increase the death benefit, increase the cash value, and thus increase the dividends that are paid out. So for infinite banking, this paid up addition is primarily used to increase the cash value as much as possible, so the dividends that pay on that cash value are as high as possible. No different than if you had a bank account and you want to put as much money into that bank account as possible so that the interest or the dividends you earn on that is as high as possible.
Now, wait a minute. When I watch the brochure commercials, everybody always says you put all this money in, but here's the benefit over investing. You get access to your money completely tax-free. How in the world... I mean, because you're making this thing sound like you're just paying for a lot of life insurance.
That's right.
How am I going to get access to my money tax free, as I've often hear people talk about?
So when we think about the cash value increase and you're dumping this money in, and we look at the average dividend rate, the 10-year average dividend rate on cash value policies is somewhere around 5 to 6%. Some companies a bit lower, some companies a bit higher. But the thing that makes this exciting or gets people excited about it is exactly what you said. You actually have the ability to take loans from the policy. So if you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods or to go buy products or go do fill in the blank. You are borrowing money from those copious amounts of cash that you've paid into the policy to build up that cash value.
Now, wait a minute, because I'm already, my spidey senses are starting to tingle a little bit here. And the fact that leverage is not something that, taking on encumbrances don't tie into financial independence, because those two words, independence, encumbrance, those just don't work. How are you going to make this work where I'm taking loans? Because aren't I paying interest rates on this stuff, Bo? I mean, there has to be a catch here.
That's exactly right. So a lot of these loans do indeed have interest rates that you're paying. Now, before we go into the interest rates that you pay, there are two different types of loans you ought to know about. There are what are called direct recognition loans, which means when you pull the money out, you don't earn any money, you don't earn any dividends on the money that you've pulled out. Well, then there are non-direct recognition loans where you do keep earning dividends on all the cash value, even what you take out as a loan. So again, I'm trying to think about this in terms of banking. On direct recognition, if I put money in my savings account and then I go to pull the money out of my savings account, I no longer earn interest on that money that was in there. With non-direct recognition, it's like I can pull the money out, but I'm still getting that. However, you've already alluded to this, these loans do bear interest. Well, if you now have an interest rate you're paying on the loan that's greater than the dividend that you're receiving in the policy, it does not work. It falls apart. So there's another feature, because these insurance companies that think of everything, where they make available what are called wash loans, where you can go take a loan out of the policy and you can guarantee that the rate you pay in the policy matches the dividend rate so that it doesn't flip upside down. But as you can imagine, if you're trying to get one of these policies that has non-direct recognition loans, and those loans even operate as wash loans, what's likely going to happen is either the costs and fees of the policy are going to be greater, or the rate of return they're willing to give you through the dividend rate is going to be lower. There's going to be a cost somewhere.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean, my head's spinning a little bit on this. So because this is not anywhere that I'm seeing on social media, maybe we ought to take a few steps back and at least, why don't you bring this back to what are the benefits they're at least telling me I'm going to get out of this? Because right now the details are making me feel like I'm swimming upstream on this. So at least let's break it back in a little more elementary. Tell me what the brochure says the benefits are.
So let's look at the brochure. Very first thing, we already said this. They tell you, hey, the dividend rate will be 5 to 6% or more each year. And if you look at the 10-year average dividend, so you can think about that kind of like interest rate on your savings account, dividend rate on your cash value, somewhere around 5 to 6%. Returns on the policy are guaranteed. So that's not like investing in the stock market. In the stock market, the market can lose money. It can go down. If you have a cash value, whole life, high dividend paying policy, there's likely going to be some guaranteed rate in there. So your money can't go down in value. So a lot of people like the security around that. So that's another brochure benefit.
There's got to be a catch to that. I know you're going to cover the catches in a minute, but there's got to be a catch to tell me I can make 5 to 6% guaranteed, because we have it in all caps for a reason. There's got to be something more to it.
Let's keep going with the brochure, though, because the other thing they say is, hey, not only do you build this cash fund, not only do you have this capital that you can use, life insurance also offers protection for your loved ones in case something were to happen to you, and it's there forever. It doesn't go away at some point in time. So not only do you have this bank that you're building where you can get the money out, but your beneficiaries, your loved ones are taken care of if something were to happen to you. And I think this is the biggest benefit that people really, really dive into this. Your money will be accessible when you need it. Unlike a 401k plan where you have to wait till retirement and you can't access it until you're old and decrepit. So this is what they say. Healthy dividend rates, guaranteed rate of return, life insurance protection, and you can get to the money when you need it.
We've done this all wrong because you spent the first 10 minutes going through all these definitions, complications. You should have started here on the brochure. This is good. I mean, I can get behind this. This sounds really good.
This you'd sign up for.
5 to 6% guaranteed. I get life insurance for my family, and I can actually get access to the money. What could go wrong? This sounds perfect. I can see why this is what I'm finding on social media.
But now let's talk about the reality. In reality, only the cash value is growing at the dividend rate. So we're going to show you a case study in a moment where all that money that you're throwing into this whole life policy, not all of it's going to cash value. And so not all of it is getting the dividend rate applied to it. Even in the early years, you're not really building up very much cash value at all. So maybe it's not as great as just a savings account right now paying 5 to 6. There's one piece. The second piece is if you want some of these bells and whistles like non-direct recognition loans where you can take a loan and still earn dividends, or if you want wash loans where you can make sure you never have a disparity between the rate you're paying and the rate you're receiving, it's going to cost more. They're going to lower the dividend rate that you receive on that.
So these are all the things that have asterisks on them.
These are all the asterisk things.
Okay, keep going.
How about this one? Fees and expenses can eat into your return. Nothing we've talked about right now actually covers the mortality expense fees or the commissions that are paid on these types of policies. That's a whole separate subject that we're not even broaching here. And then this one is a big one. Surrender fees typically don't go away until you've had the policy for at least 10 to 15 years. So what happens is you're signing this insurance contract saying, yes, I'm going to perpetrate this strategy. But if I change my mind and I decide I want to move away from this, if I want to get out of this at some point in the future, I'm going to be penalized from doing that. Well, all of a sudden that makes it sound like, well, maybe this isn't my money. You know, at the bank, if I don't like my bank, I can pull my money out and I can go choose a different bank. With the insurance policy, if I decide to pull my money out, I get penalized for not carrying in my part of the agreement.
I want to go back to something we covered a little earlier. If the Consumer Reports found the average rate of return is 1.5%, that has to mean that people aren't getting the 5 to 6%. Because we even went and pulled back when Consumer Reports came out with the article. Some of the dividend rates were actually up as high as 7%.
Yep.
So it's not like this is a different interest rate environment or things have changed a lot in that aspect. What I think is interesting when I started doing a little deeper dive on this, if you need your money in the first 3 years, that surrender fee is going to eat you alive because a lot of the initial premiums is going towards commissions and other things. So there's going to be a steep surrender fee. So that's controlling your ability to vote with your feet on the front end. And then if you live to be a ripe old age, and the back end is going to get really crushed because the cash value is actually going to be paying the much higher cost of insurance. Am I reading this right?
Yeah, that's right.
So you don't really, this banking on yourself actually has a lot of asterisks and catches is what I'm hearing. And by the way, if I can, for all the people who say putting your money in a 401k is putting your money in prison because you can't touch it, this is a better way. How do you get past the surrender fee?
You call this Alcatraz. If putting your money in a 401k is putting it in prison, putting in this feels like you're putting in Alcatraz. Something that can't be broken out.
This doesn't tie to what I'm seeing out there.
And then this is what you just alluded to. This money is locked into a complicated insurance product. So all of us can kind of understand, if I have my money in a bank and I have it in a savings account, I need to go get it. I can go get that money and I can get statements on that and understand what's going on. Well, now we have this alternative to that has a lot of asterisks, but maybe the numbers will be compelling. Maybe when we look at an actual policy that's actually been designed for this strategy, maybe then it's going to click. Maybe then we're going to say, aha. So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent. So let's assume that you have Infinite Banking Isaac. And Infinite Banking Isaac is going to put $10,000 per year into a high dividend, whole life paying policy in order to carry out infinite banking. That's what Isaac's going to do. And so the dividend rate we're going to assume, which is the dividend rate as of right now in 2023, is 5.2%. And the non-guaranteed values assume that this rate stays constant for the entire life of the policy. What we're saying is we're going to lock in 5.2%, and we're going to assume it does not go down even if interest rates fall. So we're trying to stack the deck in favor of the illustration. Make sense? All right. We're also going to say that by the time, since we're doing paid up additions, since we're buying more insurance, At age 65, the non-guaranteed cash value, this is from the illustration that an insurance agent actually provided for us, the non-guaranteed cash value will have grown to $532,000. The non-guaranteed death benefit at that time is $897,000 at age 65. Now, this is an important thing to mention. When Isaac first started buying this policy, remember the whole idea is I'm going to dump a bunch of cash in, I'm going to buy paid up additions throughout the life of the policy. When he first took the policy out at the very beginning at 36,
age 36,
it was only a death benefit of $196,000.
Okay.
So that $196,000 death benefit over the next 30 years grew to be $896, but it didn't start at $896 because I think that is something worth noting. His cash value by perpetrating the strategy went all the way up to $532,000. So the question is, what does his investment return look like?
Now, before you give us the aha moment, I want to make sure I put it out there. First of all, thank you to the life insurance agent that was willing to come forward and just share it with us. I mean, because it's hard to get information on these type of products. So to actually have somebody come and say, hey, I use these. I think I'd love to get your take on it and share it. We're not doing this just to straight up just rip it up. Mm-hmm. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. So with all of that, and then thanking the insurance agent, what's the rest of the story?
So here's the rest of the story. Over this 30-year time horizon, if you look at the $300,000 that was paid into the policy and the guaranteed cash value of $532,000 and the guaranteed death benefit of $896,000, the actual rate of return that was received in this policy, 3.62%. Over this 30-year period. When you think about the return on capital that was deployed into this policy, 3.62% does not get me super, super excited. And this assumes you didn't actually use it for the number one benefit that's touted from it, which is borrowing money from the policy through time.
And now, I know earlier you showed it on the assumptions page. This thing was paying over 5%. Mm-hmm. So for it to have returned 3.6, is that because it's back to what you said? You're only earning off the cash value, and then that's net of fees and all the other things that are coming through.
There are fees coming through, and then a portion of that every single year, every single month is paying for the insurance. So it's not like you had all $10,000 working for you or all $10,000 having that 5.2% dividend rate applied to it. Now, again, these are not numbers that we did. This is from an actual insurance policy. We just calculated the rate of return, 3.6% over the 30 years. So then the immediate question we have is, might there be a better alternative? Might there be something that looks different? If we were not going to do infinite banking, what would the Money Guy team do? How would we approach this? Well, we said, all right, let's look at Manny the Mutant. And you guys have seen Manny the Mutant a few times on this show before. And let's assume that Manny wants the exact same protection as Isaac, but he's also going to just invest the remainder in the stock market, right? So Manny, a 36-year-old male in excellent health, goes out and gets $1 million 30-year term policy, right? And I say $1 million because we know at the end of Isaac's policy, it was worth about $896. We kind of rounded up. 30-year policy, $1 million of coverage. It's going to cost him $788 per year to have that term policy in place.
Now, right out of the gate, he's going to have a lot more life insurance protection
for the whole time
than the whole life. So he's even though he's only paying $787 versus the whole life is paying $10,000. He's going to have almost 5 times the coverage.
That's exactly right. Instead of $196, he's going to start with $1 million. And then we're going to say, okay, well, we're going to have the same cash outflow as Isaac. So he's going to invest the remaining $9,212 into the market and earning 8%. We're just going to use an 8% rate of return for a 36-year-old investing for the next 30 years. How does this play out? Well, there would still have been a $300,000 capital outflow by Manny, but at an 8% rate of return on the dollars that were not buying the life insurance, right? That were not buying that, the $9,200 that was going into the market would be worth almost $1.2 million And from 36 all the way to 65, because remember, it's a 30-year policy, there would still be a $1 million death benefit in place for Manny the Mutant. So when you look at these two stacked up next to each other, you have the infinite banking Isaac, who has $532,000 of capital available. But then you have Manny the Mutant that has $1.2 million of capital available. Isaac has almost $900,000 of life insurance coverage at the end of the policy. Manny had $1 million for the life of the policy. Isaac's money that he was investing, if you look at it, was making 3.6% in the single product he was investing in. Manny, the money that he was putting to work for himself, was making 8% over the long term.
Now, we need to be completely transparent, though. Age 66, the life insurance gone with this term.
It does.
The cost of insurance is going to be so expensive
exactly
now because the underwriting is going to have to be done again. You would probably just not be able to afford the life insurance. So that $1 million will disappear.
Yep.
But I mean, it was one of those things when I saw this case study and I was looking, I was like, but that's okay, because realize, as we showed in the best case scenario for the infinite banking, the death benefit would be $896 and the cash value would be $532. Mm-hmm. You don't get to keep both.
No,
you only get either or. So the only way you get the $896 is if you die.
That's it.
Versus, at least with the investing, buy term, invest the difference, you at least now get to have the assets and then use the assets, and then your heirs get the assets later. Yep. You don't have to die to get the higher number.
Yep.
Am I getting this right?
No, you're saying exactly right.
But I don't want this, because once again, it's coming off they don't put this in the TikTok videos, that's for sure. What are things we left out to try to make this as rosy of a scenario for this situation as possible?
Dare I say that what we've laid out here is the best case scenario. This is the best outcome, because here's what we did not talk about. This is the stuff we left out. Fees and commissions can be very high for whole life insurance. If you're buying low-cost index funds, the internal operating expenses are super, super low. We didn't even factor either of those pieces into the equation. We also assume that the non-guaranteed dividend rate at 100% of the current dividend scale today, right now with elevated interest rates. We know that the dividend rate right now is around 5.2%. Oh, in reality, over the next 30 years, it could drop. If we see interest rates come back down, there's a really good chance the dividend rate could also fall. We did not even factor that in. We also assumed, and this is probably the biggest assumption, there were no loans taken out. So the whole point of infinite banking, of banking on yourself, is that I can use myself as a bank instead of having to use the bank. Well, if you do that, all the numbers get smaller. They go down, they get lower. So if you actually use this strategy the way that it was designed to be used, it actually looks worse. It's going to hurt the illustration. And then we just assumed an 8% rate of return for investing. If you look over the last 30 years, if you would have just bought the S&P 500, the broad 500 largest companies in this country, it's annualized almost 11.3% over that 30-year period. So we kind of stacked the deck in favor of infinite banking and tried to be conservative on the Manny the Mutant side. And I still think it just doesn't make sense. I could not get there as to why this would be something that would be a strategy that I would want to carry out.
So it's complex. There's opportunity cost potentially with it, and all the guarantees have lots of disclosures and other things.
Lots of costs to the guarantees.
So here's my thing. Look, life insurance is a very valuable resource when you're doing financial planning. And I don't want people to watch this and think we're anti-insurance. We're not. I actually own quite a bit of insurance. I try to protect. I minimize risk as much as possible.
But all term.
It is all term. I just want to make sure, though, that people measure twice, cut once. Because a lot of times, especially with financial products, read the fine print. There's a lot more going on beyond the brochure. And a lot of people, when you hear people who are trashing 401ks, which if you think about why are 401ks so successful, is because it's not only your money that's working. A lot of times your employer is giving you absolutely free money to participate in this. To walk away from something that has got so many incentives and benefits and tax favored status, you have to go, man, there has to be a catch. And that's why I do appreciate. Now, look, I know there's probably going to be people. I'd invite you, leave comments. Tell us things that maybe we didn't think about. But I also, once again, want to thank that insurance agent for opening up his books, to kind of letting us see a best case scenario. I'll be curious to see what feedback he gives us after he watches this show, because he doesn't know the results of what we're going to do. But it is one of those things, I feel like there's so much information that we ought to just have covered this the way we did. And I hope that the Money Guy family, this was helpful for you guys. Bo, what other final words would you have on infinite banking?
Yeah, I just think that anytime you approach a financial product or a financial strategy, it should not be so complicated that you can't understand it. And if you can't understand it, ask someone else to explain it to you. And if they can't explain it to you, ask someone else. We tell our clients all the time, when we recommend a strategy, when we recommend a solution for you, we want you to be able to leave our office, go to the supermarket, and be able to explain what we explain to you to the person behind you in the supermarket. And if you can't do that, then we've not done a great job of explaining it to you. Don't feel like just because you don't understand something or just because something sounds complicated means it's good or it's right for your financial situation. Make sure that you are the general of your army of dollar bills, that your army of dollar bills needs you to be. Don't be sold by someone trying to spin your head and convince you that you need something you don't really need.
Yeah. I mean, this is one of those cases where buyer beware. Do your research. I mean, the SEC.gov, all the government regulatory boards, they have lots of information on buying insurance, on buying your first investments. Guys, do your research. An educated consumer, Bo's already kind of shared this, is a better consumer. And that's one of the things we're trying to do, is just give you enough information where you'll do a little bit more digging, a little more due diligence to figure out, how do I walk this journey and build the best financial life for my family so that I don't have regrets, that I don't fall into traps, and I don't get myself in a moment where I look back and go, man, what coulda, shoulda, woulda happened if I'd have just known there was a better way to do money. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team, out.